Expectations are nil for the Federal Reserve to raise rates at its April meeting and are pretty low for a June rise as well. Now, is this because the US economy is too weak or the global economy too fragile? Or is it simply that the market is just not conditioned for rates normalization? Well, with me to discuss this is Themos Fiotakis, FX and rates strategist at UBS. First of all, Themos, what do you think of the US economy? Is it too weak?
I would say stable. Some indicators have improved on the industrial side. Some spending indicators have been weaker than expected. So stable, I would say, overall.
And what about the global economy? Is it too fragile?
Well, we have moved from a period where we had significant global risks to a period of stabilization because of monetary easing. So risks, but on a positive sign here.
But what you really think is that it's about the relationship between the market and the Fed, and it's about whether the market is conditioned for a rate rise. And I just want to go to our first chart so that you can explain this a bit more clearly. Here we have the effective Fed funds rate against what's the shadow Fed funds rate. Can you explain that?
So this is a chart that the Fed produces themselves, and it's important to understand that the Fed does not just tighten by raising rates, it tightens also by the language and the signals that it sends. For the last year and a half, the Fed has been quite hawkish. That has led to a level of tightening in financial conditions which has been more than 25 basis points, which is what they have delivered. And the question is how much? This is one way that the Fed is quantifying it that shows that you have seen a significant tightening from arguably a very accommodative point.
Yes.
And there are other indicators. For instance, our measure of non-bank credit throughout the last year has tightened the most outside the great financial crisis, the most that we have seen in the last 15 years.
So this means that there's a skew between what the market thinks and what the Fed is going to deliver.
That's right. And how the market transmits it through financial conditions is equally important. And this is why the Fed is at the moment quite cautious. They need to create the market conditions that allow first the rest of the world to stabilize, and second, the US economy to suffer from less risk. And part of the surprise element here for markets is that these financial transmission mechanisms have been less than apparent. So for instance, the link between dollar strength, oil weakness, credit, lower oil prices hurting credit, and tightness in global financial conditions is something that is reasonably new, and the Fed is examining, including the whole market is examining at the moment.
You mentioned the dollar. Let's look at our second chart, which is the euro against the dollar. The red line is where it's been moving, but the OECD has a different direction for the direction of euro dollar.
So the blue line here, or the OECD PPP, as is mentioned, is an estimate of the fair value of the euro.
Fair value. PPP is
purchasing power parity.
Yeah.
That's correct. Now, we have seen the euro decline at levels well below fair value. There's a reason for that. There's a 2-year-long story about divergence, but this says that a lot already is in the price. And the question is what moves the needle here. What has moved the needle here has been the weaker dollar, mostly because of the Fed basically taking a step back, assessing the financial conditions mechanism. And this is probably a mechanism that continues to drive the euro towards the attractor, which is fair value, until the point that it starts meaningfully affecting the ECB's inflation forecast.
Yes. So your conclusion about where the Fed is going to take its rate normalization policy, it's planning to, it says 2 more hikes this year. Is that right?
That's right. We think that after a period where the Fed conditions the market, where the rest of the world has some room to recover, the market will give room to the Fed to start normalizing rates, probably towards the end of the year, probably by a couple of times. But, the path matters. And within that path, the Fed must not make missteps. April
is off, clearly.
Yeah.
June is off?
Perhaps.
And so the earliest you would say is September at best, yes?
Around Q3, end of Q3, Q4, somewhere around there.
Themos Fiotakis, thank you very much.
Thank you very much.